Welcome to Trade the Trend, a weekly video about where the stock market is going. This video is going to focus on the SP 500. I'm going to cover the ASX 200 as well as gold and some of the commodities in a separate video. I'll leave a link for that in the description section below. I'm also going to show you a couple of danger points for the market, something to keep an eye on, so make sure you stick around for that. As always, this is general commentary. It doesn't take your personal situation into account. With all of that said, let's get to our first chart. And here we have the SP 500. And there are lots of interesting things to talk about this week. So last week I was talking about, you might remember, I was talking about the possibility of some sort of a bounce, maybe off the 50-day moving average. And there were some tentative signs on Thursday and Friday. I'll just jump quickly to a 4-hourly chart. We'll just get this a little bit better, a little bit clearer. So yeah, last week when I was recording, there were some tentative signs that we're getting some sort of a bounce, but that didn't follow through. This buy the dip possibility didn't play out. We've got this sharp decline over the which kicked in on Tuesday and has continued through the week. So coming back to the daily chart, so does this sell-off? Does this sell-off mean we should be bracing for a larger decline over the coming weeks? So that's something I want to go through and have a look at in this video. So the first thing I want to do, I want to put on some Fibonacci retracements. Now I'm going to use the May low, and then of course we have the high point from July. And when we put these Fibonaccis on, you can see the market has just come into the upper region of the Fibonacci retracements. And I said a couple of weeks ago, I said that a pullback to around 4,400, which is around the top of the Fibonacci region, would be quite proportional given the size of the rally that we saw. So it's what we've seen over the last week. It's a different path to what I was thinking. I was thinking that maybe we could get some sort of a sideways consolidation, or perhaps a bounce and then another decline. So your classic zigzag type correction, but instead we've got an extension of this potentially initial wave down. And overall, I don't think anyone should be surprised that we have seen this pullback towards 4,400, because we've got to remember, in the space of 2.5 months, the S&P 500 put on something like 14%. So that's a big gain in a short period of time. And what we've seen so far is we've seen the price action pull back below the 50-day moving average, but it's still above the 100-day moving average. And those moving averages continue to rise. The 50 is starting to roll a little bit, but overall, you'd say the moving averages remain in an upward trend. At this stage, I'd say that the current pullback fits the profile of a correction to an upward move. And this is why, and this is exactly why I've been saying why I kept saying for several weeks, as the market was up around that 4,600 level, kept saying, look, this isn't an asymmetric entry point. At some time, we've got to pull back towards those moving averages. That's what the market's doing now. So this in itself isn't a particularly surprising event. And what is interesting to do is I want to go across and look at, I'm just going to drag this chart across just to the last significant upward move. And I want you to have a look at how the market behaves during this move. So the 50-day moving average, the 100-day moving average, look at how many times within this advance, the market comes back somewhere in between the 50 and the 100-day averages. It sometimes even overshoots the 100-day average and then still re-engages the trend. So what we're seeing at the moment is not out of character with a rising trend. So I think it's way too early to be saying, well, look, the top's in, this market's got to come back. This is well within those parameters that you see a pullback within a rising trend. And I think our base case should be that perhaps it's something like this that we saw back around October, November 2020. And I'm not predicting this is what it's going to look like, but just say it did, just for argument's sake. let's say we saw something like this. I think something kind of like that should be more the base case rather than something like December, January 2021. I think it's more likely. I think the higher odds scenario is that we have some sort of consolidation. And what's interesting, just let's say, like I know this feels pretty can feel pretty shaky at the moment. And look, I don't know. This could get worse. It could continue to trend lower. I don't know. I'm just looking at the possibilities as I'm seeing them, and I could be completely wrong. Maybe this is a significant top. Maybe the market's pulling back all the way to the October lows. I don't know, but I just don't see the evidence to support that at the moment. That could change, but at the moment I don't see it. Now, let's suppose something like this would develop. What could that look like? And this is just to give you an idea of like a possibility that could happen other than something completely dire and a market going back to the October lows. Say we got something like this over the next several months, where the market does try and rally, and then we have another scary type of sell-off. Then it finds support and starts to move higher again, and that could be around November, December, if that sort of time frame were to be repeated. So again, this is not a prediction, but just so you can see on a chart what it would look like. So say you were looking at it at this chart in 12 months, in 6 months' time, and this is the sort of structure you were looking at, would this be completely surprising? I think you'd say, well, look, that looks like it could be completely reasonable. May look completely different to that, but the idea is I want you to have in your mind there are possibilities that can be quite constructive that could play out. So we just, it's boxing yourself into I'm negative, things have to fall. Well, they don't have to. So let's just see how this one plays itself out. I'm still holding positions. I'm still long the market. That said, I'm not ready to buy this dip. While I say there's not enough evidence to support a big decline's underway, there's not enough evidence to support buying the dip at this point for me either. So I'm holding positions, not ready to buy the dip. I also know where my exits are. This is very important. If my base case loses traction, so that's for this sort of consolidation of some description, if my base case loses traction, my plan B is my stop loss strategy. So I've got an exit level, I've got an exit strategy and process in place should things sour and continue to sell off. So it's not boxing myself into a position saying the market has to go up. Doesn't have to do anything. It's being prepared for various possibilities. And some people hate it when I say, oh, look, the market could go up, the market could go down. Well, I've got to tell you, it could do either, and I don't know which one it's going to be. So I'm preparing for either possibilities with the way that I play this over the next several weeks. Now, let's very quickly just look at the Nasdaq, because it's a really similar story. We've got the big rally, which was basically unchecked, only some small consolidations along the way. Now we're getting the pullback. We're getting the pullback back to those moving averages. See what happens. You'll remember I spoke about the divergence we saw several weeks ago. So the SP 500 made a new high, the Nasdaq didn't. Divergence is a really interesting thing to keep an eye on, because it's a clue. It gives you clues when a market is losing momentum either to the upside or a downside. So just those little things to keep an eye on, to keep in mind. We can just quickly put some Fibonacci's on. Let's use the April low. When we use the April low, we're kind of getting into that Fibonacci region now. So look, maybe it's somewhere around here we do start to find the Nasdaq start finding some support, maybe around that 100-day moving average. We've just got to watch and wait and see how it unfolds. I think look, either way, I think that the next several weeks, I think next several months could all be part of a consolidation phase. I think this is going to take time to work through. I don't think we should be looking for new highs in a hurry. I think we're probably going to have to give this time. Maybe it's going to take us through September, October, November. Let's just wait and see. Let's see how it plays out. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Let's YouTube know you're watching, and YouTube will then do what they do and show other people. And that helps me a lot. So please do that and hit that subscribe button if you haven't already done so. So real quick with the Russell 2000, the small caps, yeah, look, it's just pulling back since it hit that resistance point a couple of weeks ago. It's coming up to some short-term support around 1,820, but this is really all still range-bound. There's no great direction to this. We really need to wait and see when we get if we get a break above around it's around 2,000. Got to get the market above there. Got to get the Russell above there, and to give it some momentum. I believe that's the key to getting a recovery in the small caps. We're looking for a breakout from this range. And now a couple of things to keep an eye on this week. US 10-year bond yield has continued to increase. So you'll remember we spoke about this back in July, and we got the breakout. Then we pulled back, and then it started to regain momentum. It's look, rising yields. Rising yields are likely going to be a headwind for the stock market, and hence this is all coincided nicely. So we spoke about this as a potential headwind, and now we've got the rising yields and the pullback. All these things have been happening at the same time. Got within a whisker of a new high. The October 2022 high got within a whisker of that during the week. Don't be surprised if this kicks a bit further and continues to pressure equities in the near term. And the other thing I quickly want to show you is the US dollar index. So this is the index of the dollar against a basket of major currencies. And I spoke about the false break a few weeks ago. I won't go through that again. Although when a market fails to fall when it breaks, it tends to be a sign that it's going to test the other direction, and that's very much what we've seen. Testing this trend line resistance, and what we have, we've basically got a range. We've got a range that goes back to January that the dollar's been mostly tracking in, except for this little blip to the downside. We're now testing the trend line resistance from that range. See what happens here if the dollar breaks through there. Again, another headwind for the stock market. So look, a few things to keep an eye on. Some really interesting things going on in these markets. So let's keep a close eye on what's going on. Thank you for joining me. It's been great speaking to you again. Hopefully gives you a few ideas. I look forward to coming back and talking to you next week. Till then, bye for now.